Your 401k alone might not be enough. Taxes and the growing uncertainty around future tax rates due to America's rising debt could drastically reduce your retirement savings. Today I'll show you exactly why relying on a traditional 401k alone is risky, highlight some common pitfalls that catch retirees off guard, and most importantly, towards the end, I will share some actionable steps to help you secure the retirement that you've always envisioned. For those who don't know me, I've been investing for over 15 years now. I've made almost every investing mistake that you can think of, and I make these videos so you don't make those mistakes and share what has actually worked for me. Your 401k is a great tool, no doubt. Tax-deferred growth, employer matches, and automatic payroll contributions. And it's especially useful if you're in your peak earning years because you're deferring taxes to a future date when hopefully you will be in a lower tax bracket. But is it a flawless one-stop solution for a comfy retirement? Not exactly, and here's why. First, you don't truly own all that money. A traditional 401k is a pre-tax account, meaning you haven't paid taxes on that money yet. In simple terms, if you see $1 million in your 401k, you might only have $700,000 after taxes, depending on your tax bracket, of course. Second, the future tax rates. As of right now, the US national debt is over $36 trillion. That's trillion with a T. By the time you watch this video, it could be a lot more. And you might wonder, why do I care about that? And here's why. Eventually, the bill comes due. And the government has two main ways to deal with debt. Either cut spending, which has never been a popular option, or increase taxes. And guess which one will affect your 401k withdrawals? Financial advisors and experts are increasingly warning that higher tax rates in the future are almost inevitable. So today's relatively low tax rates might actually be the lowest you and I will ever see for the rest of our lives. Think about that for a second. If you're in your 30s or 40s and saving for retirement, the withdrawals you take in your 60s or even in your 70s could be taxed at higher rates than today. To put this into perspective, if you have $1 million saved in a 401k under today's rates, if you withdrew $50,000 a year, maybe you will pay around $6,000 to $8,000 in federal taxes, just as an example. But in a future scenario, say that the tax rates are 10% higher across all brackets, that same $50,000 withdrawal might now cost you $10,000 or more in taxes. Over a decade-long retirement, that difference is huge. In plain English, plan for taxes to go up, and you won't be unpleasantly surprised if they do. And if they don't, well, you planned for the worst and came out ahead. Third, the one topic that does not get talked about enough, RMDs. Let's say you hit 73 years old and you haven't withdrawn from your 401k at all because you did not need the money. But then suddenly, you get a notice about required minimum distributions or RMDs from your 401k. Basically, the IRS is saying that it's time to withdraw your money. Why? Because the IRS hasn't collected taxes on that money yet. In fact, by law, once you reach a certain age, you must take out a portion of your 401k each year, whether you need the money or you don't, so the government can finally tax it. Again, it doesn't matter if you need the money, you're forced to withdraw a portion of it. And fourth, Social Security benefits. One of the most overlooked aspects of retirement planning is how 401k withdrawals can make your Social Security benefits taxable. The key factor here is the provisional income. The IRS determines whether your Social Security benefits are taxable based on this calculation. Your AGI includes withdrawals from your tax-deferred accounts like 401ks, traditional IRAs, and your pensions. Just as an example, let's say a retiree receives $24,000 per year from Social Security and withdraws $30,000 from a 401k. This withdrawal could increase their provisional income enough to make 85% of their Social Security benefits taxable. These are the 4 reasons why you should pay attention if you have all your money in a traditional 401k or even a traditional IRA. So what can you do about it? What are some of the solutions? Consider Roth contributions. You contribute to a Roth IRA or a Roth 401k with after-tax dollars, so you don't get an instant deduction. The money grows tax-free, and when you withdraw it in retirement, it comes out tax-free, as long as you follow rules like being over 59 and a half and the account being at least 5 years old. That means that if your Roth grows to $1 million, you really have $1 million available. With a Roth, you don't care if future tax rates are 25%, 35%, or even 95%. Most companies now offer a Roth 401k option. A decade ago, Roth 401k was barely heard of, but now it's actually very common. You can also do split contributions. For For example, some people do a 50-50 split. Half their 401k contributions are pre-tax and the other half are Roth. Then consider Roth conversions in your low tax years. If you find yourself in a lower tax bracket in a certain year, consider converting some of your traditional 401k into a Roth IRA during those years. Yes, you will pay taxes on the conversion, but you can potentially fill up a lower tax bracket. It's like filling up your tax bracket bucket at 12% or 22% right now, then potentially 25% or more later on. Over time, these conversions can significantly reduce the taxable portion of your retirement funds. Finally, plan for healthcare. Medicare obviously does not cover everything, and things like long-term care can be a huge expense. Look into long-term care insurance or set aside funds for HSA. So part of beyond 401k planning is considering these contingencies so that your 401k can be used as intended for regular living expenses and not get wiped out by surprise expenses or bump you into a higher tax bracket due to emergency withdrawals. Here's my own story with a Roth conversion, right? I started doing Roth conversions for a portion of my 401k. That's where you take out money from a traditional IRA or a 401k and move it over into a Roth account, paying taxes on it right now. The first time I did it, writing a check voluntarily to the IRS felt weird, right? Because who chooses to pay taxes early? I did not convert everything, but I was strategic with my conversions. Having some pot of money in Roth form by retirement is a smart hedge against tax worries. One warning though, I'm not saying that dump all your money into a Roth account and never use a traditional 401k. Traditional 401ks still have immediate benefits, especially if you're in your peak earning years or if you're in a very high tax bracket right now and expect to be in a lower one later on. The real takeaway is to diversify your tax situation. You've probably heard of the saying that don't put all your eggs in one basket. Well, it applies to investment accounts as well. Ideally, you want to retire with multiple buckets of money taxed in different ways. Tax deferred bucket, which is your traditional 401k or your traditional IRA, where money will be taxed on withdrawals. Then your tax-free bucket, this is your Roth IRA and your Roth 401k, and even a health savings account if used for medical expenses. Money that comes out tax-free. Then you have your taxable bucket, which is your brokerage account, your high-yield savings account, where you pay taxes along the way on interest, dividends, or when you sell an investment. Having all three really gives you flexibility. In a given year of retirement, you can decide which bucket to pull money from to manage your tax bill. For example, in one year, say you're close to jumping into high tax brackets, so in that case, you could tap into your Roth bucket instead of your traditional 401k bucket. Remember, the goal is that by the time you retire, you're not looking at just one big 401k pile. You're looking at a few different piles, maybe a 401k, maybe a Roth option, some HSA, and maybe some taxable investments as well, which together form your total wealth. You could also add real estate to the mix. Remember, the top marginal tax rate in the US once exceeded 90% during wartime, and even in the 1980s, the highest tax bracket was over 50%, well above today's top rates. I'm not a fan of fear-mongering, and given Trump's inclination towards lower taxes, it is likely that we'll experience reduced tax rates at least in the immediate future. But if your retirement horizon extends 10, 20, or even 30 years from now, you'd be wise to keep an eye on the ticking US debt clock.